Hey everybody, it's Chris Kirkpatrick with Life 180, and I'm back here for the And Asset mini-series with my buddy Caleb Williams, who is the CEO of Better Wealth. And so in the last video, we talked a little bit about the And Asset and what it was and how it works. So if you're just kind of stumbling on this video and you haven't seen video 1 in this series, please go back and watch that before you get into this, because this may not make complete sense until you watch that. But what Caleb did last time was he went through kind of a summary of the overall what the And Asset is and how it kind of works. This video is going to get a little deeper into the weeds, because most people, as we were talking about, have a lot of questions. I think most of the questions revolve around, okay, this is great, it sounds awesome, but how do I actually use the money? What does it look like? When you say I control my money, what does that actually look like? And you know, and then we talk about like cash flow, future cash flow, future use of the money. So let's walk through that.
Right. So some of the most popular questions that we get is, okay, Caleb, I get the theory, I get the concept. How does this work? And no one will tell me how. And I actually had one of the biggest compliments the other day. Someone says, Caleb, you were the first person that actually explained to me how this works. And my hope is to create this video so that you can have a better understanding, whether you like this concept or not, an understanding of what's actually going on and why they can make this happen. So, watch the first video if you haven't already, but my thesis is the And Asset gives you your dollar more than 6 jobs, but I just highlighted 6 areas, and if you can get your dollar to enhance all 6 of these areas, you're gonna win by default. Now the question is, Caleb, how does you actually use your money, and this also ultimately translates into how you use this at retirement, okay? So I think there's a couple things. We're gonna do kind of like a history lesson here, not necessarily a history lesson, but we're gonna understand where the money is flowing. So we're gonna draw, again, your stick figure. We're gonna say this is you, Chris.
All right. And
we're gonna say you are saving to your And Asset. Now, essentially what this is doing is the And Asset is a contract, and we're just gonna do, it's a contract between you and the insurance company, okay? Now, when we talk about an insurance company, we're talking about a mutual company, which means that you are the owner. It's kind of like a credit union. You have part ownership of. They pay dividends, meaning some companies, cheaper the price of insurance, but we don't necessarily care about the insurance to begin with. We want the cash, and so we want companies that pay us. Yep. And there are other benefits. We want companies that are safe, that are financially strong. So we are partnered in this, but the And Asset is essentially this contract between you, the payer, the insured, and the insurance company, the one that has all the money and that is on the hook for this insurance. Okay, so that's where the And Asset is. And just as a quick summary, the And Asset is we are maxing the cash. Okay, we're maxing the cash and minimizing the cost, meaning we want to put as much money in and get the least amount of insurance benefit as possible. It's just a good review. It's like, we want a contract, but we want this contract specially designed. We want it optimally designed to maximize, again, what we want. Okay, so how does this work? You get this set up. How do you use the cash? So number 1, we're gonna say that this is your And Asset. In my book, I call this the master account. And let's say, just for simple math, you have $100,000 in here. And remember, Chris, this money is growing the rest of your life and will pass on to the next generation with even more money. And so just alone that this financial vehicle, it's not just worth $100,000, it's worth what that $100,000 can do over your lifetime, but this $100,000 is just what you have available to use. Yep. Now, there's 2 ways that you could use this money. You could take this money out. It's your plan, you have total control, you can do that. The problem is, once you take that money out, you can't put it back in, and that money is no longer able to grow for you ever again. The shocking thing was, my first car that I purchased, I didn't know this, I paid cash for it. I thought that was the greatest decision, but I paid $10,000 in cash for that car. Whoops. And it will probably cost me over $300,000 over my lifetime, because that $10,000 is never working for me ever again.
I think we all have done that.
Yes, I mean, everyone has. But again, that's just a micro example of using your money has a cost too, and it's called lost opportunity cost. And we really want to understand that every decision that we make has a consequence. So here's the summary here. So your money's growing. You have your insurance company. That's a massive company. They have just millions and billions and sometimes trillions of dollars as it relates to floating around and influence over. And so they have this money and that they're putting it to work. And essentially, you could take your money out, but we already said that that's not the most efficient way to get that. So now we're going to say you're going to use your money. And there's two types of ways that you can use your money. There's a liability and there's an asset. A liability is cars, vacation, you just want to use your money because you can.
Quality of life.
Quality of life. And guess what? No one's telling you can't. And in fact, if we're getting technical, we're using this as a loan, but this doesn't affect your,
long-term growth.
No, but it doesn't affect your debt. It doesn't affect your, what am I trying to say?
Credit rating.
Credit rating. It's not a typical loan that people can see. So you can use it for liabilities.
Yeah.
My favorite is when people use it for assets. They invest in businesses, they're investing in real estate, they're investing in things that actually can produce an extra rate of return.
More value. Yeah.
More value.
Yep.
Okay, so what we're actually doing is we're borrowing against your cash, and we're actually taking from the insurance company. Now, the contract that we go back to, the contract is built in with guarantees saying, I can have access to my cash value, and each company is a little bit different, but in most cases you can have majority, I like to say 95% access to your cash value to use, and they're not going to ask you what you're doing with it. They're not going to ask you, when you have to pay it back. It's an unstructured loan, meaning you have total control to use it in however way you want.
Yep.
Okay, so you're taking this money from the insurance company, you're putting your money up as collateral. So let's say you're going to take $50,000. So we're taking a $50,000 loan from the insurance company, and now I'm going to say $50,000 here. So $50K is up for collateral, meaning if you cashed out your money at this time, you'd only have $50,000. If you died at this time, you get the death benefit minus $50,000. And every time you make a loan repayment back to the insurance company, this lien is going to go smaller.
Yep.
Does that make sense?
Yeah.
Okay.
Totally.
So essentially, at this point, you're taking a loan, and you have the total freedom to pay this back whenever. And let's say you pay this back over 10 years, okay? Because you can. Maybe it's 5 years, maybe it's 1 year, maybe you don't pay it back at all and you wait and pay it back in a lump sum, or you never pay it back and it's structured in such a way where you're gonna die someday and the death benefit's gonna pay it off. I don't know, but the concept is you get whatever your money's doing, whether it's buying an asset, whether it's buying a liability, you get the benefit of that, and then you decide if you want to put this money back. Now, what's the benefit of paying it back? The benefit of paying it back is your lien gets smaller when you pay it back. That includes more cash for you to use. Now, a common misconception is, Caleb, if I get a loan, my money's only growing at my dividends and interest are only growing at $50,000.
Yeah.
All the money that's not in a lien. And when you have it set up with the right company, your dividends and interest get paid on the full amount.
Full.
And it doesn't matter whether you borrow against some of it or not, you're getting paid full amount. And because you're a part owner in the insurance company, it's really super beneficial, and you're hedging both sides. Now, the common question that I get, and this is really important for people to know, is how can the insurance company do this? They're essentially letting your money grow.
Yep.
They're giving you access to your money whenever you want. They're charging you interest, but they're also paying you, and because you're an owner of both, it's actually a good thing. And how do they do this? How can an institution give you a guaranteed loan and not require you to pay it back?
I mean, the question is, when you put it that way, I think most people go, well, that sounds too good to be true. So there's got to be a catch, because how can they afford to do that? Right.
And this is what I want you to know, is the insurance companies never lose, okay? The reason they never lose is they're playing a long-term game. They've been around for over 100 years. They're playing multi-generational, whereas sometimes we focus so short-term. So think about this. When you enter a contract with an insurance company, there's 3 things that can happen. Number 1, you can pay them back. And when you pay them back, they're getting an interest rate. A lot of the companies that we use are around 5%, so they're getting that back, and that's awesome. And that's paid for their loan. They're happy. Second thing is you could cash out their plan, which would devastate me. It would not be the greatest for you. But if you do that, they keep the money that they have a lien on, plus the interest. So in this scenario, I would take $50,000, be gone, and the company would keep the other $50,000.
Whatever the spread is. Yeah.
The third deal is you're gonna die. And the insurance companies are the only institution, this is why they don't make you pay your money back now. So the only institution that are hedging both mortality, death, and interest rates. And when you understand that they're doing both mortality and interest rates, and you're a part owner in this institution, it allows you to be able to benefit with these benefits, and why it sounds too good to be true, because part of the contract is you're entering in to an agreement, and they know that you're going to die someday. As harsh as that sounds, you will die, and when that happens, they're going to take what you owe them and subtract it from the liability that they already have on their books.
But I think it's key to understand, because there's a big misconception, because I think a lot of people do videos on this, and the education about this concept is wrong in a lot of areas when it comes to, okay, I have $100,000, and they say, a lot of the concept is, well, if you have 100,000, it's not yours, it's the insurance company's, because when you die, you don't get the death benefit plus the 100,000. I think it's key to understand you're not paying. If you got a $500,000 death benefit, the cost of the 500,000 is not based on the cost of the 500,000. It's based on the cost of the spread between the two. So there is a cost for the additional insurance. But even when you break in the costs, and after all the internal fees and everything, over the long term, this is going to destroy any other guaranteed product in the world. Right?
I mean, really, what you have to compare this to when you look at all the benefits is the savings account.
Yeah.
Because this has all the benefits of an ideal place to store capital. And that place only exists in the savings account. And where this blows it out of the water is you're being able to capture long-term tax advantage growth, whereas in a savings account you don't. And in a savings account you're using that money, and it's gone forever. Where in this, it's an engine that continues to work. And so, do you want to go down to what a retirement looks like? Or should we make a new video?
Let's make a new video on what retirement looks like with these. So, all right, so video 3 coming up on what retirement looks like. If you haven't already, this book is what we're talking about. All this stuff is covered in great detail in here. This is what Caleb wrote a couple years ago. And so it's called the And Asset. Click on the link below. You could buy it on Amazon for 20 bucks, or I convinced Caleb to pay for it for you. All you have to do is pay shipping, and he's gonna autograph it for you and send it out to you. So that's that.
I will say, if you want me to autograph it, make sure you message us. Because we do have a system.
Oh,
I will, on behalf of Chris,
I know.
making promises on my behalf. I will make sure to try to get to that. And
there you go.
Sure to
look at me making promises. All right, so there we go. All right, we'll see you in the next video. Take